Hey there, and welcome back to the channel. Today we're diving into a financial tool that more and more homeowners are starting to explore, but many still don't fully understand: the home equity line of credit, also known as a HELOC. If you've built up equity in your home, a HELOC could open doors to major financial flexibility, but it's not without risk, and it's definitely not a one-size-fits-all solution. So in this video, we're going to take our time and break it all down in a way that's beginner-friendly, practical, and honest. And if you're curious about whether a HELOC is right for your specific situation, reach out to us anytime. We're happy to help you run the numbers, review your options, and connect you with a trusted local lender here in Virginia. Let's start with the core concept. What exactly is a home equity line of credit, and how does it work? The term HELOC stands for Home Equity Line of Credit. It's not just a buzzword, it's an actual lending product that banks and credit unions offer to homeowners who have built up value in their homes. And just to clarify early on, the phrase Home Equity Line of Credit and HELOC refer to the same thing. One is the full name, the other is the acronym. There's no difference between the two in terms of the product being offered. Now let's say you bought your home a few years ago, and thanks to either rising home prices or paying down your mortgage, or both, you now have equity. Equity is simply the difference between what your home is currently worth and what you still owe on your mortgage. For example, if your home is worth $550,000 and you owe $370,000, then you have $180,000 in equity. A HELOC allows you to borrow against that equity. But here's the twist. It's not like a lump sum loan where you get one big check and start paying it off immediately. A HELOC is a revolving line of credit, much like a credit card. You're approved for a maximum limit, say $75,000, but you only borrow what you need when you need it. If you only use $10,000 of that $75,000, then you're only charged interest on the $10,000, not the full amount. That's what makes HELOCs attractive to many homeowners. They're flexible. Typically, HELOCs come with two phases. The first is called the draw period, which usually lasts 5 to 10 years. During this time, you can pull money from your HELOC as needed. Most lenders only require you to make interest payments during this phase, so your monthly payments are relatively low. Then comes the repayment period, which usually lasts another 10 to 20 years. During this time, you're no longer able to borrow from the line of credit, and you'll start making payments that include both the interest and the principal. That's when monthly costs go up, so you want to be prepared for that shift. So what's the difference between a HELOC and a home equity loan? This is where people often get confused. A home equity loan is different from a HELOC. With a home equity loan, you borrow a lump sum of money all at once, and you begin repaying it in fixed monthly payments with a fixed interest rate. Think of it more like a traditional loan, predictable, steady, and better for one-time expenses. Meanwhile, a HELOC is more like a financial safety net or a credit card with a much lower interest rate. You can use it, pay it back, use it again, and so on, up to your limit. Let's go through a real-life example. A couple in Centerville, Virginia, bought their home in 2017 for $420,000. In 2024, it was worth around $575,000, and they had paid down their mortgage to about $310,000. That left them with $265,000 in equity. They were approved for a HELOC of $100,000. They didn't touch it for the first year, but when it came time to renovate their kitchen and replace their HVAC system, they borrowed $45,000 from the HELOC. Their monthly payment during the draw period was about $260 because they were only paying interest. Later, when the repayment period began, their payment increased to around $480 per month. So what can you use a HELOC for? That's one of the biggest benefits. It's very flexible. People often use it for home improvements, debt consolidation, education expenses, major medical bills, or even to fund a business. Some even use it as an emergency reserve. But a word of caution: just because you have access to this money doesn't mean it's free or that it should be used carelessly. This is your home we're talking about. The HELOC is a lien on your house. If you default on it, the lender has the right to foreclose. So it's not a casual financial tool. It should be used strategically and responsibly. Now let's talk qualifications. Not everyone will qualify for a HELOC, and lenders do look at several key criteria. First, you typically need at least 15% to 20% equity in your home. Second, your credit score should generally be 620 or higher, although scores of 700 or more will unlock better interest rates. Your debt-to-income ratio also matters. Most lenders want to see that your monthly debts, including your mortgage, car loans, credit cards, and the potential HELOC payment don't exceed about 43% of your gross monthly income. Finally, you'll need to show proof of stable income, which means W-2s, tax returns, or business income if you're self-employed. And here's another detail. Most HELOCs come with variable interest rates. That means your monthly payment can change over time based on market conditions. Some lenders offer a fixed rate conversion option for portions of your HELOC, which gives you predictable payments on what you've borrowed. It's worth asking about that if you want more stability. Now for the pros and cons. The advantages of a HELOC include lower interest rates than credit cards or personal loans, interest-only payments during the draw period, and the ability to borrow as needed. It's a fantastic option if you're doing ongoing home renovations or want a flexible safety net. The downside is that rates can go up, your payments can increase unexpectedly, and you're putting your home at risk if you can't repay what you borrow. So, is a HELOC right for you? That depends. If you're confident in your income, have a clear purpose for the funds, and understand how the payments work, then yes, it can be a powerful financial tool. But if you're unsure about your future cash flow, or you're tempted to use it for lifestyle spending that doesn't build value, then it might not be the best choice. If you live in Virginia and want to explore your options, or simply want to know how much equity you've built up in your home, I'd love to help. We offer free home equity reviews, local lender connections, and expert guidance on whether a HELOC or another solution is best for you. Thanks so much for watching. If you found this helpful, don't forget to like this video, subscribe for more home ownership tips, and leave a comment below with your questions. See you next time.